Welcome to the Credit Events Podcast, a podcast for credit-savvy investors. This podcast is for informational and educational purposes only and does not constitute financial advice. The opinions expressed by the presenters are their own and do not reflect the views of Destra Capital Management. Nothing discussed in this podcast should be considered a solicitation to buy or sell any securities. Listeners are encouraged to consult with a qualified professional before making any financial decisions. And now, here's your host, Rob Watson.
Hello, everyone, and welcome to this week's edition of Credit Events. I'm excited for today's topic, event-driven credit investing. And joining me today is a special guest, Jake Schultz, investment strategist at Destra Capital. Jake, welcome to the show.
Hey, Rob. Happy to be here.
As listeners of Credit Events know, we dig into different credit investing strategies, sectors of the market. Today's topic, I think, is really timely. We're here in early March of 2025. There's been a lot of turmoil going on in the markets. So, Jake, let's jump right in. Help us unpack what is event-driven credit investing.
Sure, Rob. So, event-driven credit investing is, it's an alternative approach often used by credit hedge fund managers where the strategy aims to generate returns by focusing on corporate events. So, think mergers, acquisitions, restructuring, bankruptcies, spin-offs, refinancings, and the list can go on. So essentially the event-driven or special sits credit manager, they're working on a company's credit instrument or capital stack where they're investing in bonds, loans, and other obligations of a company's balance sheet. And really they're trying to capitalize on how those events might improve or unlock value by investing in the company. So very often, a corporate action or event that might occur, it tends to be far more focused on the company itself, really than compared to more macro market issues, such as tariffs, headline inflation, things of that nature. So, being that idiosyncratic nature in credit events, it allows the manager to really take the view of a bottoms-up approach rather than what's going on more in the macro headline market.
That's a fascinating angle. I mean, in a lot of fixed income investing, you're so focused on interest rates, duration, sort of macro dynamics. This is like zooming in much more on, kind of reminds me of equity investing, in that you're really looking bottom up on a company by company basis. So if you're thinking about it from a traditional setup, 60-40 type equity bond portfolio, why do I want to pay attention to this?
I would say it's about diversification, right? So, stocks and bonds, they're more broad asset classes, right? But just generally speaking, if you think of stocks and bonds, they tend to dance to kind of more macro market moves, as I was mentioning earlier, whether that is if the Fed's going to cut rates, if they're going to reverse and raise rates, what's going on with tariffs, geopolitical events, right? So more general market sentiment. But when you think of some alternative strategies such as event-driven credit, the focus is really on that company by company idiosyncratic event or moment. And because it's so singular focus, that lower correlation of the idiosyncratic moves allows for event-driven credit strategies to be a true diversifier to some of these traditional asset classes that many are using to build portfolios today.
So it's like adding a new flavor into the mix, almost, in a way. Can you dig into the diversification idea a bit more? What's the magic, if you will, behind that?
Yeah, I don't know if in terms of magic, I don't know if I can. Compliance will go through with that, at least on my side. But let me unpack it a bit more and walk through some of the mechanics. So special sits credit investing, or again, event-driven credit investing, is really about identifying mispriced assets where there is maybe mispriced risk. And sometimes in doing so, by identifying these opportunities, you tend to have an asymmetry of maybe the upside or potential upside that outweighs the downside. So through thorough fundamental analysis, very critical risk assessment, you're able to identify these opportunities where there is a catalyst to unlock value downstream, right? We were talking a bit about it earlier. More traditional markets tend to be more beta focused. So if they're higher beta, right, they tend to ride market waves. Markets go up and down based on market headlines and market sentiment. But in a more alternative strategy such as this, it's really more about delivering alpha, and those returns come from this identification of very unique company by company moves. And we're talking much smaller, much more concentrated type of portfolios, as opposed to more index type manager or more market beta, where there's thousands and thousands of investments potentially in strategies.
It sounds really fascinating. It makes me wonder, why don't we see more of this with investors? I mean, why don't investors have more exposure to strategies like this?
It's a great question. I think the popularity, we've certainly seen it increase a bit. But I think just taking a step back, I mean, generally we're talking about stressed and distressed debt or circumstances for companies that are, in need of financing solutions, right? So a company that's in a rough spot with their debt service, or a credit hedge fund manager identifies something that can lead to value at the end of the tunnel, whether it might be a merger, whether it might be a restructuring. It can be very complex, right? So it requires hands-on, sometimes very roll up your sleeves type of work, and the risks are real. There's certainly credit risk involved, and there's risk that some of these events that are anticipated might not pan out the way they've been anticipated. But that's why when you look at strategies such as this, you're really doing your due diligence on the manager who's managing it, right? Their level of expertise, their level of experience, to make sure that they're identifying the right opportunities and protecting the downside.
You're talking about risk. I mean, that makes me wonder, if you're in a circumstance where bonds in general are not doing well, let's say maybe like rising rates, right? What's the impact, or what's the potential outcome for a strategy like this?
So yeah, it's a good question, and we've certainly experienced a period more recently in 22 as rates rose significantly. I think if you think about general bonds, that you have two different types of duration, right? Your interest rate duration, your credit spread duration. So when rates rise, certainly more duration sensitive investments are going to be impacted on price, right? So as rates rise, you'll see a move down in price. And for more equity-like investments, stocks, they might also experience volatility as concerns about borrowing costs are going to increase. And we saw that in 22 with stocks and bonds both down, 15, 20% respectively. But when you look at event-driven credit or special sits investing, you're looking at companies that are maybe more potentially below investment grade or troubled, stress type of companies. So really the main issue for them is what we indicated earlier, is higher borrowing costs, right? So a rising environment, rates to borrow, it becomes much more expensive to do so. And for companies that on the back of COVID, maybe over levered, might have taken on too much leverage post COVID, they're struggling to meet their profitability. These higher rates are going to cause issues where they're going to need to come to the table and be more open to potential restructuring, changes of the balance sheet, et cetera. And that starts with the creditors coming to the table and the company, and there's ultimately negotiations between these lenders, and that's where a lot of these credit managers are able to add value for investors.
So, Jake, if you think about it, again, let's go back to like just a 60-40 traditional balanced type setup. From a portfolio construction standpoint, where do you see a strategy like this playing a role?
Yeah, so a lot of people we speak with, and I think alternatives just in general There's been a lot more talk lately of, is the 60-40 dad post 22? And I think, regardless of general portfolio makeup, I think the growth of alternatives has really been quite prevalent here over the last decade or so. And so I think, generally speaking, a strategy like special sits credit can offer the ability of more potential equity-like returns in credit investments. So maybe taking 5 or 10% or so from equity markets, if you're a little bit concerned about equity market volatility, where we're at in the cycle today. And then you can also certainly take from your fixed income allocation, maybe another 5-10%. And what you're looking at is potential alternative sleeve of, 15-20%, maybe a 50-30-20, 55-30-15, something of that nature, where you get the macro market moves, but you have a little bit of a diversification aspect, lower correlations when you do have events like 2022, where you see big drawdowns in both stocks and bonds.
Yeah. That's a vivid reminder. 2022 fortunately, it doesn't happen a lot that stocks and bonds go down at the same time for a whole year, or in a 1 year total return period. But boy, that really shook the confidence for a lot of people in the old classic 60-40 model. And it was just a couple of years ago, but most of us remember it pretty vividly. So changing gears here. If you think about the downside to event-driven credit investing, what risks should people be thinking about?
Yes, I think I touched on a few of them earlier, but I think really there might be, I would say there's multiple risks. There's always risks to evaluate before investing in any strategy or a manager. But I think the first one is going to be probably manager dependent. So who is your manager that's managing this strategy? Do they have the expertise, the experience to really, like I said earlier, roll up their sleeves, participate in these negotiations, make sure you have, strong, documents in terms of the covenants, protections, etc. I think another risk is certainly the liquidity. So if you're looking at a company that's, trading in a high yield index, maybe much more liquid, that's probably, not maybe a company that's a potential candidate for something that's stress or distress. So it might be more thinly traded. It might be locked up. There might be redemptions around the restructuring. So considering the liquidity risk of these companies or investments is something I would say is also very worth considering. And then, finally, there's always that aspect of event risk or credit risk, right? So you always run the risk of, is this event going to pan out the way it was anticipated? Is that, restructuring court going to approve the proposal, or is it not going to pan out? So I think those three risks would maybe be the three that I would at least touch on today for investors, and can certainly unpack that more potentially in the future.
That's awesome information, Jake. Thank you. Got any last thoughts about event-driven, or, as you have said, special situations credit investing?
I think really a lot of what I touched on earlier, it's just, kind of this alternative, kind of more alpha seeking type of strategy. You have to look to kind of go against the grain, potentially when there's a company or a credit that's, fallen out of favor for many high yield managers or others who have invested it, and it hasn't done as well for those that invested near par. But when you reverse the script, when you kind of look at it the other way, if it's still a good business, but maybe it's fallen out of favor, it's fallen unloved, a manager that's experienced and has the ability to roll up their sleeves and still find value and really create a business at a pretty low value, with kind of that asymmetry of, downside protection and potential strong upside. I think that's where you can really add value to portfolios today. And why, I think we feel strongly that this is an alternative strategy that can really add alpha to many clients' portfolios today.
Terrific. Well, that's a fair and balanced approach, Jake, if I can borrow a tagline from a news organization. So listen, thank you so much for being on Credit Events today. Jake Schultz, investment strategist at Destra Capital. We'll look forward to having you back again soon.
Thanks, Rob. Happy to do it.
Thanks, everyone.